Hi. I run a little gold fund. It's doing okay. After I speak, Ian Williams, who's been a friend for years, a mentor, and amazing, is speaking after me, and I've been chasing his performance ever since I started in this business. But anyhow, first I'm going to tell you a little bit about gold and why it's valuable and when it's valuable, and then try to talk about why you should invest in stocks in the gold market rather than gold itself. That's, signing my life away. So gold is credit. Gold is money, and everything else is credit. No currency in the world has really lasted more than a few hundred years in the last 2,000 years. The US dollar has depreciated more than 90%. The lira depreciated more than 99%. And most currencies get to a point where they depreciate themselves out of existence. The reason they depreciate themselves out of is because eventually governments, or kings or queens, in their infinite wisdom, eventually need money for war, infrastructure, bridges, you name it. And when they need money, they print money. And paper money is just credit. And eventually, they print enough of it that devalues the currency. And we all know the horror stories about things like the Deutschmark, or Reichsmark, I believe it was called. So why gold instead of money or paper currency? The reality is something like 98 or 99% of all the gold ever to come out of the ground in the last 3,000 years since man has been mining it is still available in vaults and around the necks of ladies around the world. And the amount of it is sufficiently small that we can quantify it visually. And that's the fundamental reason why gold is valuable, is because you can't print more of it. We take about 3 tons of it out of the earth every year, but you simply can't find enough to print it the same way you do actual currencies. And that's why it tends to retain its value. It used to be that there's a certain amount of gold per person, but the amount of gold available per person in the world has gone down astronomically. And the relative rarity of gold is why it is still valuable. Now, gold is a commodity, like uranium, but most commodities in the world get used, and then some get stored and recycled, but eventually you use it, you get rid of it. Gold is money, it's a currency. It doesn't get used. A small percentage of it does actually get used recently for the first time in history because it's used in electronics. But that consumption of gold is a minuscule percentage. And ultimately, gold stays around, unlike the rest of the commodities in the world. And that's why it's used as money. Now, gold goes up and down in price. It's extraordinarily cyclical. And given Ian's incredible knowledge of cycles, I'm sure he'll tell you a little bit about that. But the reality is gold demand goes up and down a little bit, but ultimately the demand trend for gold is going significantly higher. And the reason for that is 60% of the world's population lives in Asia. And those Asians have lived through even worse depreciation than the poor Americans who have been depreciated by 90%. They have spent 3,000 years watching paper currency after paper currency get depreciated. The rupee goes down at least 10% a year. The yuan is being devalued on a regular basis. So these countries or the people in these countries have learned as a part of their culture to not trust paper currency. And the more Asians that are in the world, and there's more of them on a daily basis, the more they believe in gold. And that means that the demand will continue to rise for it. Now, their demand isn't in a line. They're very price sensitive. So when gold ticks up, they buy a little bit less. But overall, the demand is extraordinarily steady. 1,400 of the 3,000 tons mined in 2015, 1,400 of them went to China for a combination of state and personal use because they wanted a backstop. And in the West, we tend to only, now the cyclical nature of gold is because in the West, we tend to invest in gold when currencies are being more devalued. So when you've had really low interest rates, as we've had for a very long time, and you have negative real rates of return, which we'll discuss later, that's when it tips, so to speak, when the cycle tips in gold's favor, because then investors in the West add that marginal demand that starts pushing the gold price higher. So as we discussed it, precious metals enter bull markets when real yields go negative. So everybody's freaking out right now because the US are about to raise rates again, probably. I'm sure they will raise rates at least 3 times this year, a good 25 basis points each time. But the reality is that inflation in the US is going to 2.5%, which means even with those rises, there's going to be a negative 1% yield. And that's just in the US. There's negative yields in the UK right now with CPI versus the base rate. There's negative yields in Japan, really negative yields in Japan. But on the whole, the base rates are low enough that if you put your money in the currency of the land, cash, you're losing money on it every day. And the more money you lose on the cash in your pocket, the more people buy gold. So the quantitative theory of money is basically a theory of how much gold is going to go up in price. And people keep saying, well, they've been printing money for the last 10 years. Why hasn't gold gone up in price? Gold goes up in price when the volume of transactions in the market goes up in price. And the growth, the reality is since 2007, we've been in a largely low to negative growth cycle. And the volume of velocity of money has gone down significantly. For the first time in 10 years, though, it's ticking up. And when it ticks up, the incredible amount of money that's been printed will start playing out in the gold price. And that trend in increasing growth and inflation has just begun, and it is part of a long-term cycle. Now, precious metals are generally inversely correlated with the stock market. You're all looking at me saying, stock markets are going insane. And they are going insane. But it's what I believe, was it Greenspan who said, euphoria of some sort. But anyhow, there's stocks go up, get overvalued, and they get incredible amounts of debt. The debt to equity levels in the general S&P, the Dow, even the FTSE right now is insane because they've had cheap debt for the last 5 years and they have gorged on it. Eventually, the markets will turn. And when the markets turn, commodities generally make money because they're considered to be real assets. But eventually they will turn, and everybody I know who's been watching markets for more than 5 years really believes they're going to turn soon. And when the markets turn, gold turns even higher. So how do you know they're not going to find lots more gold if it's going up in price? They're not going to find lots more gold because they found all the easy pickings already. The grade of gold in the ground, the average grade mined in the world, I believe is around 0.9% right now. So that means there's 0.9 grams in a ton of rock. For every ton of rock they mine, there's 0.9, you can't even, it's a speck of gold. The reality is it's hard to find. They found all the easy pickings and they're mining lower and lower grades of gold every day and having to push many, many more tons of rock out of the earth to get more gold. The trend is, it's not about human technology, it's just about how much is left. And the reality is, I think the ability to find significantly more higher grade gold is quite low, just based on geostatistics. And realistically, there isn't that much more gold to be had, which is yet another reason why, because of relative rarity, the price should be going up. We touched on this a little bit earlier, but the main driver of gold in the world, the increase right now is Asian demand. And I believe the yuan's about to be devalued again. And the Chinese truly, truly believe gold is money, as do the Indians. And there's a lot more of them than there are of us. So I assume that it's going to continue to go that way. So the question is, Why buy gold now? Gold moves cyclically. It kind of goes down in 3 to 5 year bull markets or bear markets, and then up in 3 to 5 year bull markets. It's extraordinarily cyclical. Now, I don't want to say this bull market's going to last for 3 years, 5 years, or 10 years. It could last for any of those. It should last statistically for at least 3. But we're early days, extraordinarily early days. And if all the other bull market analogs are there, we've got a long way to go. Now, those are the last, so that was the bull markets in gold and how far gold has gone in this bull market. This is the bull market in gold stocks, junior gold stocks. And that's how far we are. Now, generally speaking, so that's the 2001 bull market that went till 2007. The one on the bottom is gold. It went up 218% over that 6-year period. I mean, that's great appreciation. I'm sure you'd all be very happy to have gotten 218% return over 5 years. But if you were in large cap gold stocks, which is what the Huey index is, you went up 630%. Because gold stocks are beta to gold itself. And that's large cap stocks. Small cap stocks do even better. They on average do 4 to 5 times the underlying gold price. So the reason for investing in gold and gold stocks, especially the juniors, if you can pick them, is because you will make money if you're in the right part of the cycle. And I truly believe we are in the right part of the gold cycle to be investing. I run a little gold fund. It's done reasonably well over the last year. And you pick on quality. What I would say, if you're going to invest in gold stocks, especially junior gold stocks, you don't know which ones are going to hit and which ones aren't going to hit. You just simply can't. You have to invest in a diversified basket. And you have to do a lot of homework and really know what you're doing to invest in those stocks. If you're willing to do that homework, which given that you all subscribe to LSE and you look at these stocks in depth on a regular basis, do that. But if not, Ian and I are very happy to help you out. Anyhow, I'm going to get going now and let Ian talk about silver, which does even better than gold in a gold bull market. So I'll let him go from there. Thanks.